Everybody joining us, thank you to ARM and the other organizers and my fellow panelists for joining me on stage. Today we're going to be talking about a topic that is dominating a lot of the thoughts and headlines around funding, and talking about what makes deals and ultimately what breaks deals. And so when I was talking to Rita at ARM about the structure of this panel, what we discussed was bringing folks from different walks of life within the funding environment to explain their perspectives on the field, what makes kind of a good deal for them, how they see the field, and then ultimately end on what we see as happening hopefully in the near or midterm future. So with that, we're going to go through a quick, maybe not so quick round of introductions, because I think we could do some slides potentially. And then we're going to jump into some questions. I'll start off asking one or two questions, and then I know we have like the beatbox question box roaming around probably somewhere, and we'll go to the audience to see if we have questions, but if not, we'll just continue on. So with that, I'm going to start with Valerie to my left.
First, thanks for having me on this panel and for being at the conference. I'm Valerie Dixon. I'm a managing director at Morgan Stanley. I've been leading our efforts in the life sciences tools and diagnostics effort for the past 5 years, but I've been in investment banking for 18 years. So I guess in the title, I'm one of the deal makers. Some might say deal breaker, but mostly deal maker.
Deal breakers.
Hi, everyone. Daniella Kranjac. I'm founding partner at Dynamk Capital. I've been there for since its founding about 5 years ago. And prior to that, the rest of my 2 decades, maybe closer to 25 years of experience as a co-founder at Wave Biotech, and then subsequently at GE Healthcare. So I've been both on the technical founding side as well as the corporate acquisition side, and now on the VC and private equity side. So spanning a little bit of different perspectives. Both, to Valerie's point, I think both a deal maker and occasional deal breaker, but mostly deal maker. So proud of that.
Thanks, Matt, for inviting me to the panel. I'm now an operating partner at Casdin Capital. I've been here rather recently. My purview is mostly life sciences tools, diagnostics, and omics companies. Previous to this, I was the founder and CEO of a company called Isoplexis. That's where I met Matt when he was at Lonza. We founded that company, grew the company, IPO'd the company, and then sold the company in a 10-year or so period. And then prior to that, I somewhat of a deal maker, hopefully, at Lazard, in a junior role. So not really a deal maker, an analyst. Excited to be here and talk about this sort of environment and path forward.
So I think, Daniella, you're going to kick us off with a couple slides, and they do have your slides up, I can see.
I am. I do have a couple of quick slides. We're going to run through these very quickly, just for kind of an orientation on the market and what we've been seeing at Dynamk Capital. Obviously, lots of headwinds that we're being faced with. And at the same time, tailwinds continue to propel the industry. I think the important theme for us is that great science will continue to get funded, and really understanding that the new modalities, all of the innovation sorry, we're losing.
We lost power.
Yeah, you lost it.
Let's.
Oh, there it is.
Hold on. Okay, let's try that again. So innovation, really what we're viewing is continuing to drive across the sector. But a couple of things that are helping us along here, and I speak specifically from the sort of tools and technologies perspective. So when you think about the enabling technologies, tools, services, everything that biotech and pharma rely on to do what they do, whether it ranges from discovery into manufacturing, even into delivery methods. And so for us, we're really all about those enabling technologies. We've seen, obviously, the renewed interest from the US plans in support of biotech and biomanufacturing advancements last year, $2 billion overall that was committed. At the same time, as we're seeing all of that innovation and really promising science, we're experiencing a lot of other headwinds, the recessionary fears, inflation, maybe a slowing M&A market, although there are bright spots still happening. I know Valerie will chat with us about some of that, as well as IPO activity, which perhaps a potential opening of that window, but not quite yet. So as we look to the landscape, a couple of observations. For anyone who's really interested in following us, we actually put forward a quarterly insights newsletter that is distributed to our subscriber base. Have a look at our website. You can sign up there. But basically, we've seen that certainly deal size, total capital investment, as well as the deal count, market drop from obviously 2020, 2022 levels through the pandemic. But interestingly, with 3 quarters complete, and this is data that reflects through Q3 close that we compile really for life science industrials, showing that these are kind of on par with 2018, 2019 levels, and perhaps even surpassing that. So really, everybody thinks it's a tough environment. It is a tough environment, but it's not as tough as we think the numbers are showing us. On the M&A and the IPO side, you can see obviously the same kind of trend, but M&A and IPO, that is a very lumpy sort of data point anyway. You see some outliers there with the Danaher Cytiva acquisition, as well as Thermo PPD and Aldevron, PRA. Those are obviously skewing that, but even when you remove those, you see a pretty healthy trend here. Perhaps most useful to note is that we have seen that there's over $250 billion in dry powder, and that has got to get deployed at some point. So hang in there. For the technical founders. To the multiples, and I think maybe giving a little bit of context as to what we saw previously, maybe pre-pandemic levels of 3 to 6x on multiples, revenue multiples for exits in our space. That obviously went to really 20x plus revenue multiples during the pandemic and just post. That really we viewed as an unsustainable ecosystem anyway. And so this retraction that is happening now, the new normal, some of the more recent transactions sort of in the 10 to 15, maybe outliers to beyond, but 10 to 15x, really a healthy environment for that. And so we really are excited about what's happening in the field and the science that's happening. So I'll wrap there and open for discussion.
Valerie, I know you wanted to make some comments?
That was perfect. But the only change I would make to that is it's not a new normal. It's a reversion to the historical mean. It's the old normal. And I'm having conversations now, both with public company managements and boards and private company founders and boards. And they have this perception that if they can just kick the can down the road and stretch their cash for another year, or another 2 to 4 quarters, that we're going to come back to an environment of irrational exuberance like we saw in 2020 and 2021, and they're going to be saved by the white knight and get 15 times forward revenue for their company, and that's not happening. So I think the way I think about funding cycles is in 5 to 10 year increments, not 2 to 3 year increments. And so you need to be managing your business such that it's about long-term enduring growth, profitable growth, hopefully. But that needs to be the mindset, getting back to fundamentals and thinking about how you set yourself up for long-term success, and therefore setting up your backers, the funders, to enjoy in that success with you. It gives you much more credibility when you can tell a story about how you're investing for long-term growth. And then they'll be there for your expansion capital or your growth capital when you need it. And if they take that long-term mindset with you, that means that you can have confidence, that they're going to be the patient capital that's going to, grow with you along the way. But everything you said is absolutely correct on the funding environment. I will say there have been signs of life in the IPO markets the past few months, post Labor Day in particular. But there's only been 9 healthcare deals done this year. 8 of them have been in biotech. And as I sit here, right now, only 3 are trading above issue price. So just because you're getting public doesn't mean, everything's great. You still have to pay attention to aftermarket performance. You still have to hit your quarters. And not just, the first one out of the gate, which is critical, but, be consistent in that execution and a good steward of the capital that you raised. Because, if you look at the 2021 vintage IPOs and how they're, performing today, some of them as low as, 80-85% off of, original issue price. It's because, maybe they got public too early, or maybe they took the eye off the ball, or any number of factors, management teams that weren't seasoned enough, weak boards. All those, things play into, how successful your IPO will be, ultimately. But, 6 months out is too early to call.
Anything to add, Sean?
Yeah, just echo, great presentation. I think there's a recognized challenge with quote unquote subscale companies, right? I think that there's a recognition that cost of capital's gone up, right? That it might be here to stay for a little while, and then, so if you're in the public sphere and you're burning cash, it's what's the return on invested capital here? Where do we get to? Discounting those future cash flows. What is this worth today? I think this creates a problem with, just generally speaking, valuing companies that are subscale and burning cash. I think that because of that, it has been a somewhat of a dearth of deals, right? Which affects all of us, right? When less deals happens, there's less of an obvious sort of put or backstop on these companies, which then creates valuation challenges, right? Like, how do you value a company? A lot of times during the 2019 to 2022 period, research analysts might say, well, I can understand your liquidation value is going to be X, right? Like X hundred millions of dollars or something in the sale. When there's no M&A going on, that number is more difficult to come to. So then people are sort of saying, well, how do I value your earnings? Okay, your earnings aren't there. So how do I value the company? So I think that there's the good thing, frankly, is the industry tailwinds, which we just talked about, are still very strong, right? Like there's still this huge push to invest in new therapeutic modalities by the big pharma, right? Investing in new technology is going to be huge. I think, what is the market for biomanufacturing? Quote some research report, it was like $130 billion or something crazy. And they're investing in new technologies quite constantly. So from an investment perspective, that's attractive to us. It's just thinking through, frankly thinking through when we invest in companies now, what is the return on invested capital we're getting? Are people shepherding that capital in this kind of higher cost of capital environment, really closely? And then Valerie, you're gonna know a lot about this, but the consolidation theme is critical, I think, to everyone over the next couple of years, and how that plays out in the subscale company environment, because there's so many companies out there that I think have great products, great end markets, but difficult to support their own entire company operating expenses.
All right. So we're going to jump into a couple questions, and probably I'll start with the ones that I think are on everybody's mind from your perspective. And I'll kind of combine 2 or 3 together and just work through them. So, the first one is from your experience, what is the guidance you can offer to founders in order to get term sheets to actually materialize? And then how are you helping them work through what Valerie referred to as our old normal in relation to valuations and check sizes they might receive as part of that. So,
I think I can jump in there.
sure.
Although there's not a sort of crystal wand to to get the deal sheet and to secure it. I think in this environment, a lot of firstly, maybe to Sean's point is really thinking about who do you have at the table, being probably the most critical question for you in this environment and for the foreseeable future. So really having board members, investors who understand what is going on in the market, who can be value add for you in terms of bringing additional relationships, whether it's relationships with an investment banker or relationships with strategics or distribution relationships, anything of that nature, talent networks, I think is really a differentiator in this market. Really what guidance do we give them? It depends. If they're sort of early stage and you're a technical founder in early stage and still have that luxury of being pre-revenue and not having those reportables on a quarterly or monthly basis, you have a little bit of flexibility there, and you probably should be raising what you can when you can. And not waiting. And in this environment, sort of the guidance that we're giving our portfolio companies and even companies that we're looking at going forward is really don't wait. There was a number of folks that kind of early in the year said, we're going to wait until the fall when the market's better, or we're going to wait until JPM 2024 when things are going to be great. Just don't wait. It's really, really stressful for everyone involved, I think, around the table. And then as you're getting to later stage, really focusing on the business fundamentals. In other words, it's not growth at any cost. It's sort of make sure you're doing responsible growth and you're hitting a series or a combination or potential combination of milestones that will get you that next inflection point. And I think, to their credit, some of our technical founders in the audience have done just that this year in a really tough market, and they've been able to raise at increased valuations, which we're thrilled about. But that's really a testament to their hard work and sort of really driving those milestones.
One thing I would add to that is you have to look at alternative or creative sources of capital in funding environments like this. IPOs and VCs used to be 80% of capital into new companies. The remainder of that were things like corporate partnerships and things like pipes. And I think you need to exploit that a little bit more when there's really no line of sight into a capital markets exit. And Daniella was right. There's a lot of dry powder out there. And the first thing I do when I talk to someone, a founder who's looking to, raise capital, they'll come to Morgan Stanley and say, I'm looking to raise $100 million. We want you to be a placement agent. The first thing I ask for is their investor log. And it's usually one of two things. I'll get an investor log that's like 10 or 15 names, and half of them they haven't spoken to in 6 months, which is an eternity for a VC. And the other half, they've spoken to 100 people, and they've talked to them every single month and have a different story every time. So I say, look, you have to be organized and systematic in your approach to how you're raising capital and be credible. And so that means having a consistent message, hitting the milestones that you say you're going to hit, even if you're not raising money, giving an update and saying, hey, just want to let you know we hit this milestone and this milestone. Hope to catch you at JP Morgan in 2024, but maybe we'll be ready to bring you into our next round then. Like it just creates a little bit of scarcity value. Like I'm the new kid on the block and I'm doing things that are going to be differentiated, and you're going to want to follow my story. And when it's time for me to raise, you're not hearing from me for the very first time.
I'd say I'd just jump in. That was my thinking was, when I look at like what I'm actually recommending to a bunch of companies is increase the size of the funnel. Like your capital raising process has to be thought of as a normal sales process where you have the number of shots on goal is going to increase your probability of raising the money. I think you have to be, in this environment, really creative about how you can enlarge your funnel. And I think part of the problem for at least for the companies that I see is also investors have switched around what stages they play at, right? Which is like the investors that might have been, I think we were talking about like IPOs and they're crossover typical investors. Well, some of those have decided, what am I crossing over into? What am I funding? I'm looking for different types of milestones. Some of those have sort of ceased to exist at that funding phase, which creates a gap. So increasing the size of the funnel, and then definitely being kind of thinking about, being creative about how you think about like dilution or whatever, right? And so, some people might say, oh, I don't want to partner. I mean, Matt, you're on the strategic side, but I don't want to partner with a strategic. It's like, because that makes me look like I'm beholden to one strategic. But on the other hand, maybe a group of investors says, well, it's really good validation. Right. If you license something small to that strategic and get an investment piece with it, that really increases our confidence level, right? So it was like I felt we had a big strategic investor when we were private, and that was very helpful to me personally. It's changed, right? It used to be that you could go it alone and pursue these various capital paths, and I really do think that being creative about your funnel is important. The other thing is definitely like sort of doing what you say you were going to do, or at least somewhat. I think that's really important. You both said, both Daniella and Valerie, sort of hitting your milestones, like just being sort of at least implying you have a strategic vision, saying, hey, I wanted to do this, and my revenue is not random. It's really devoted to this big market that I'm creating or that I'm disrupting. And I think it sounds cliche, but that's actually harder to do, right? And say I'm pursuing this path and I'm actually achieving my goals on it, not looking at the next shiniest thing. So those two things.
Yeah, so maybe the next topic on this, again, combining a couple things. So, I mean, Valerie and I think Daniella made the point that this is the old normal. There's no magic date to get to in order to, be back into the exuberance, as you put it, as, 21, 22. But is this, to be honest, is this as good as it gets? Or is it going to get better? And, I think that's a question that probably most people have. Is this what we're going to be dealing with going forward? And then, are a lot of the spending habits that we're now dealing with, are those persistent, or might those change as well? Should things get better?
You mean spending
from
a company point of view,
yeah,
and
sure.
what they're... Well, I think I have a perspective on this, and as I have a perspective on a lot of things as people who know me. But I think that, understanding for us as an investor, we have a ton of rigor and sort of constraint around the spending, and I don't know that that's consistent across the entire investment community. So when we look at sort of budgets, annual budgets within a board context, we're really thoughtful about that spend and where that spend is going and and that's kind of ingrained in us because we are coming from an operator background, at least I am and most of my team is. And so that, I think, really imparts a different view to that sort of exuberant spending approach. Is this a new normal? I think it is for some period of time. I mean, the retail investors have sort of left the building. And so with that, until they come back, which to Valerie's point, that cycle is sort of 5-10-year cycle, we may not see a return to that for quite some extended period of time.
I think we're cresting over we're starting to hit bottom. I don't think we have yet. I'm eagerly awaiting third quarter results from a lot of public companies even, and to see if there's a change in sentiment from the investor community, even on the public names, not even thinking about like the VC community right now, because I think a lot of the VC community, smart money, they're just waiting to, find the bottom and start buying and spending cash again. I hope that's the case. But it's hard to see around the corner. I mean, I was having a discussion last week with the CFO about doing a refinance, and he asked the question smartly, so like, is there something that can happen in the environment that would make, these rates go up or down? And my capital markets partner said, well, there's a lot going on now. Like, you got Ukraine, you got inflation, you got all this stuff. And he says, if there's another geopolitical event, and it's almost like he predicted, like the attacks in Israel. And I'm like, I wake up, 4 days ago, and this, this is going on, and I'm like, well, that was prescient. But you're not managing your balance sheet anticipating World War III, but you're managing your balance sheet anticipating that you need to be managing your business for a 3-year time frame, at least 2, but a 3-year time frame, not for next quarter, not for just making that month's quota, not just for getting to year end. And if you do that, you're going to be a better steward of VC capital. And so whatever unexpected issues arise, whether you feel like you're at the top of the cycle, middle of the cycle, and bottom of the cycle, you can at least get through and survive and find ways to, either, tighten the belt or double down on investment because you see an opportunity at the right time, to make those investments when everyone else is running scared.
That's always easier to do, right? I mean, if
Right.
you're fundamentally performing as a business and then you see an opportunity for expansion, it's way easier to go back to your existing investor base and say, hey guys, we are absolutely firing on all cylinders, but we need to go chase this opportunity now, and we need to raise some money to do that, and then you get the support. But if things are sort of not in order,
Yep.
and you want to chase other things, it just becomes real difficult for investors, and definitely in this environment, not happening.
I was just going to say, I think the public, I think when you see major divergences, like long-term historically, they don't make sense, they're going to revert to the mean, right? I don't know when, I can't predict when, but you look at there's just large cap versus small cap price to earnings divergences don't make any sense anymore. People just don't like small cap, right? The revenue multiples for DX, like the small caps have just, if you look at these things, it looks crazy. Like it goes down, they're the same, and then it goes down like this, and it's almost like half a turn or something, 0.5. Those at some point will revert back to sort of the long term, not the 2020 to 2022 when the small caps were going like this through the roof, but to the long term. I think that's a good thing for small caps, but it's a really difficult environment for the next year or two as far as capital raising for anyone. There's no question. That's public companies. Private companies, it depends on what's the subsectors in life sciences tools are very different, which we all know, right? Like there's the analytical tools subsector right now, while that was screamingly hot a couple of years back, right now, it's difficult to do deals without some degree of price, being affected by price in a negative way, and also being affected by structure, which I think, again, that structure might have been normal in 2010 or something for life sciences tools, but no one's seen that for like 15 years or something, so something like that, right? And I think that that's inevitably also going to get better, but only when people feel good about the small caps, right? So it's all like lagging in some respects. So I think it's a matter of time. At the same time, though, I think that I'm excited about, look across a number of companies, I'm excited about all those companies, and they can position themselves for a different type of investment round. I think the one thing we constantly think about or recommend is like, hey man, if we can reduce the burn a little bit and prove that the burn is really smart and that it gets us to 2026, perhaps when it's a different M&A environment, we can talk with some quasi-predictivity on what that might look like. And what I say is like, being reasonable about the exit environment, that makes investors feel better than, hey, to get to our proof point, we have to burn a ton of money and raise money again in 2024. So.
Right. So Daniella kind of made a comment around M&A and doing that in a smart fashion. I mean, Sean, you've been through that, and you made an interesting comment on the prep call about sometimes being unsure whether you're joining friends or competitors. So maybe talk about that a bit.
Yeah, I went through my own M&A experience, and I would say, like, this was public when it came out in the press release. I think we had 70% investor support and all this fun stuff. Like, it was meant to be. I think that company was then sold again, which happened recently and sort of consummated. I think it's when you're founding a company and you're getting off and you're ramping your revenue and doing all this stuff, you didn't imagine that the capital markets environment would sort of collapse around you. So you just have to be resilient and sort of figure a way out. I think the environment, I do think relationships are really important, right? Like, I guess I would say that, and I would say for what I saw in my personal M&A experience, it was the longer, the companies that could understand our story, and again, we ended up being sold to one company, but the companies that could understand our story were the ones we had relationships with, or the CEOs for like 5 years, right? So to some respect, that was a benefit, and in an environment where you're either selling the company or you're raising lots of dilutive capital, you're making a choice. But I still think, understanding the other players and the relationships are extremely important in M&A. And in my recommendation, maybe sometimes it feels like to the growing companies that you're sharing information with the strategics and they're going to use it or something. I think most often, at least from what I've seen over the last 20 years or so, that's not the case, right? Most often you're developing a relationship that, of the 50 companies that they think about, or 100 companies, they might actually remember you in that, in an M&A sort of context, when you actually your investors might want to sell, or you might want to sell. So I don't know. I don't know if that answers your question, but that's
how. Yeah, no, it does. Does anybody from the audience have any questions about funding, M&A? Yep.
I think you have to wait for the...
She's bringing up the mic real quick, actually.
Oh, that's a mic.
Yeah.
Oh,
what is that?
Okay, to speak into the X. Okay, IRA Act. It's having a little impact, a lot of impact. Where do you put that in terms of your list of criteria, looking at companies in terms of what their success rate is going to be, or their burn rate is going to be, as they're attacking a market that's got all kinds of uncertainty?
I'll go for it. So I'll go. Everybody's looking at me. I feel, the IRA, certainly in terms of impact on innovation, we are concerned about that in the overall grand scheme of things. I do think it's going to force some hard decisions around which pipelines advance and which get shelved and so on. Because we are servicing the industrials market, the life science industrials, it's a little less of an impact to us, I feel, in terms of direct to our whether to our portfolios or to us as a fund or as a firm, I should say. But certainly the innovation and the effects there will maybe stifle some of the adoption of novel technologies. That being said, I think there's a ton of room for improvement on reduction of cost of goods, improvement of access, improving quality, particularly when you're talking about advanced therapies. There's a ton of room for improvement. So I do feel strongly that that's going to continue. We're going to continue to see the dollars impacted there. But overall, in terms of just being frugal and being rigorous and having that operational rigor around your businesses, I think is going to be key.
Yeah, I mean, I'll make a comment as well. I think there's so many parts of the IRA, and there's so much that's unknown still. Multiple companies have filed suit against the Medicare negotiations, and Chamber of Commerce had their lawsuit not thrown out, but certainly didn't get an injunction before everybody now has agreed to go into these negotiations, because they feel like they have to. And I think that the point is that if that happens, then that's ultimately potentially going to have an effect, but we don't know necessarily yet. It may affect the indications that companies ultimately decide to pursue and what they decide, and it may change significantly the strategy around, say, BLA submission, because it would be there'll be a lot less incentive to do rare indications in that context, right? So you're going to you may have a huge impact on approved products and rare indications. I think on the other side, on IP, I mean, the exclusivity window shortening for small molecules is likely going to have an impact. I mean, if you have a smaller window in order to recoup investment for research and ultimately other activities before that becomes an option for generics, then that's going to impact the way that investors look at companies and invest in pipelines. I think that those decisions may have been made because some of the explanations that were given were that the majority of the products in Medicare that were being reimbursed at a high rate were small molecules. But the fact of the matter is the Medicare represents a lot of times the market, and the market is still at least a plurality, if not a majority, of small molecule. So, of course, it's much more likely that a lot of those will be included in Medicare versus, say, biologics and advanced therapeutics. So I think, there was a little bit of, we probably could have done a bit more deeper analysis on that, but ultimately this is what we have. So we're seeing some adjustment probably in the future. Any other questions? I see a hand, and here comes the box.
So we hear a lot about the dry powder building up on the investment side. You guys touched on it a little bit. What do you see as kind of the key catalyst that'll see that deployed in any meaningful way? And I guess the second part of that is, what do we think, is there a shelf life for that dry powder that's building up?
From our side, flexibility on terms and valuations. I think we certainly are seeing that already. I think we had a discussion recently about what advice do you give a technical founder who's getting a term sheet that they weren't expecting. So buckle up. I think it's probably a good deal. There's a lot of investors that are looking to sort of de-risk. And to deploy in this environment now, you've got to be absolutely assured that you can sort of see that value creation from when you're coming in, and it's very, very difficult to come in now if the round was priced in the prior market. So just an observation, which is lending itself to, obviously the flat rounds and the down rounds that are, I think, to come. So not to be doom and gloom, but I think to maybe Valerie's point, we haven't maybe bottomed out yet. So we're going to continue to see that. But I think being flexible, being creative, being open to sort of alternative structures, looking for non-dilutive financing is another option, right? You can sort of, not to put Matt on the spot here, but look to the strategics and look to those deals that you can strike around that environment to bridge you. But I think for us, when we look at deals, it has to be a compelling valuation and terms on its route, absent the market. And so I think we've had that rigor. Maybe some folks have not exhibited that in the past market, but that's going to be really important to open things up.
I think there's this, everyone saw there's this dollar amount, and I can't remember what it was, but it was like there's X many dollars available in dry powder, but even that dry powder dollar, if you look at the cash burn and what people needed to raise across life sciences company types, it was like 3x the dry powder. And again, people have attenuated what they thought they were going to spend. So I think that as people, I do see it now happening now, but I think that as companies do, one, change what they think they need to spend to get to either break even or some. This is life sciences tools, not therapeutics, but break even in some environment in the near future. One, that helps quantify the investment and makes it more appropriate for the investors in this environment. But I think the other side is valuation and structure, right? So it's can I come, if you're saying I need I'm gonna make it up, a $200 million valuation, but you don't have a product yet, and you're saying that, I also need to raise another round, it's tough to do the quantifiable math when you compare it to what you think the public market environments will look like in 3 to 5 years. So I think as people adjust what they're going to do with the cash, and then valuation matches what an exit environment could look like, that's where more of the dry powder gets deployed.
Maybe a little insight as to how investors think about rounds for the audience. I think just to build on Sean's point there, we looked at something recently that was somewhere in the neighborhood of $100 million valuation. The round that they were raising was attractive, the team was attractive, everything sort of ticked, but when we looked at the fundamentals, we thought they're going to be raising another round in 6 to 12 months. And if they hit those milestones, we're willing to sort of pay, right, for that premium. If they don't, that's going to get repriced. Mm-hmm. And so for us, kind of having that rigor is saying, we're going to wait. We're going to wait and see how that materializes. So again, sorry to say that it's going to continue to sort of stall out, but it's going to maybe take a little bit more time to work things out.
So we'll end the doom and gloom, and we're going to talk about opportunities in the field. So what have you all seen that excites you? I mean, obviously we've had, just to preface, we've had multiple approvals this year. Mm-hmm. We have 2 others that are for significant, for the same indication, an SCD coming later this year, hopefully. So it seems like we do have some tailwinds, at least on commercial approvals. Is that something that excites you, or what else is coming that is exciting?
I'm super excited about cell and gene therapies and the enabling tools that go along with it. That's where I spend all of my time. And I'll quote somebody who's probably here, but he says all the time, dead cells don't cure cancer. And what he means by that is you have to have all the tools and elements and technologies in place to enable you to get your drug ultimately to, manufacture and commercialization. That means the tools that help with potency, with stability, with purity, with QA, QC. You can't take your eye off the ball on the manufacturing process. Somebody mentioned that a couple panels ago this morning. So all the companies that I track and are meeting with, like the BioLifes and the Rooster Bios, the cell media and media supplements businesses, the Mackay of the world, the people that do the storage and distribution and logistics. All those are so important to the supply chain and ecosystem of what you all are spending, all this brain power and innovation in the lab to bring to market. And if I'm focusing on those things, but if you guys focus on those things as well, then it'll be a better environment for everybody to, bring the innovation to market.
I'm going to thank Valerie for the shout out on Rooster, which is a portfolio company. But I would also sort of build on that. The portfolio that we have, we're really thrilled about what we've put together. And so for those of you who may not be aware, there's I think 5 or 6 portfolio companies here. Selfie, Curie, Excel, Rooster, Verica. I'm probably missing one. But that's really, for us, the excitement is just seeing them bringing their products to market, really realizing their full potential and servicing this entire really important industry. So for us, that's kind of the excitement in terms of novel things that we're looking at. I'd say, automation is certainly top of mind, but automating suboptimal unit operations is not really, maybe not, at least my bias, not really the way to go. So just rethinking processes and manufacturing and looking at those opportunities in a different way. We're excited about a lot of things in the space. So not all gloom and doom, really exciting science.
Yeah.
Yeah, agreed. I mean, cell and gene therapy, bioproduction, still very exciting. I think the end markets, I remember back in just, let's say I was discussing this with my investors and my board back in 2017, and I think at that time, Novartis had kind of shied away a little bit from cell therapy, and people were asking questions about Kite and Juno, and people were saying, wow, I told you cell therapy is not going to work, right? And it's like, I remember all the clinical data, and I remember showing it to our board being like, it's got, these are crazy durable response rates, and it's got to work. And flash forward 5 years, and everyone's, saying this is going to be a mainstay. And now, I think right now people are like, well, I don't know, maybe we got too ahead of our skis and things. And I think that the reality, if you look at just the numbers and the targets and everything in cell and gene therapy, this is like just the iceberg, right? Like, especially like some of the gene therapies, there's so many things that need a gene fix to create a protein that does something that it's very early stages. So supplying those two markets is incredibly worthwhile. And we're very early on in that cycle. If you just look at the cycle that happened with monoclonal antibodies and everything. And I think the other side is when I think of therapeutic companies, drug development and academic researchers, translational medicine, sequencing companies on the one hand have done, especially Illumina, have done a tremendous amount to sort of help us understand the genome and transcriptome and things, but there's really been a range of these proteomic companies that are actually making an impact, whether it's through whatever your proteins are in your serum or on the histology or spatial or at the single cell level. And I think that that's also just right at the beginning, even though some of the public market companies have been kind of crushed in terms of valuation and everything. I still think that's like very early stages of being something very big, because it kind of goes hand in hand with mastering or precision medicine, which like in some degrees I look at the data now. Again, precision medicine, if you look back in 2012, you're like, oh, the hype is gone, like it's not going to make sense. And you look now, and I mean, maybe this is a different data set. Maybe the data set was picked because I think it was by the Precision Medicine Association or something, but it was like these drugs are save $1 billion overall through $1 billion overall for every sort of program type that you have in a pharma, and they're 30% more profitable. Like, so I don't know where all that comes from, but logically it sort of makes sense. It's a little more precise. You're failing fast in some buckets that don't make sense. And so I think proteomics and precision medicine and then cell and gene therapy are super exciting, and I think we'll make it through this kind of challenging phase, and the sort of clinical tailwinds are on the long term are much, much higher.
Yeah. I think bringing it back to the subject, there was a big wave, and in Daniella's chart you saw when there were huge acquisitions with outsourced manufacturing, Aldevron being the $9 billion kind of elephant in the room that Danaher bought. When you start seeing like Thermo Fisher's and Danaher's and Sartorius making big multi-billion-dollar acquisitions in the space to have capacity for cell and gene therapies, that's that's your wake-up call. I think we've hit pause now because the biologics enabling tools now are not at the scale that makes them pay attention. There's a lot more conversation about development, but I see the M&A activity in this area picking up in the next 3 to 5 years when some of these companies that I named and other companies out there really start to get to the type of scale, hopefully with more approvals, where it becomes a part of the broader landscape with some of the major life sciences tools players.
Maybe to your point, Valerie, I mean, I think also looking back, a lot of the tools and tech haven't really been purpose-built for cell and gene. And I think I myself am guilty of that with Wave. It was sort of a convenient realization that we saw we could grow T cells in a Wave bioreactor in sort of 2003. That was well ahead of time, and it still hasn't really been a purpose-built device for that application, right? There's much more that we could be doing in the space.
Yeah, I mean, it brings up an interesting point that, a lot of people believe that we haven't made enough progress in the tools, automation, services space, but to Sean's point earlier, there was a lot of people that were saying that cell and gene therapy was not commercialized. It was never going to be able to commercialize. It just didn't work. So I guess the question is when did the time actually start for us? Was it 2015 with some of the first treatments? Was it 2017 with the first commercial approvals? And do you see, at least we could pick one area like automation or QC, but do you see things starting to accelerate in terms of development?
I mean, I personally see a definite acceleration. I think there was maybe a little bit of, that sort of technology adoption curve, and thinking about the trough of disillusionment and then sort of the uptake and adoption that happens after. I think we're still on that sort of early end of that adoption curve for thinking about things that are going to really move the needle in the space. Maybe in 2013 or 15, thereabouts, was sort of a realization that this might actually merit investment from some of the larger players, which was nice to see. But I think they really need to, again, in this environment with the cost of capital, with it, they need to be able to do M&A deals that are going to be accretive, not in many, many years. We're talking 1 to 2 years accretive. We're talking probably profitable businesses or borderline profitable businesses. And so that's where they'll do the bets, I think, now.
Yeah, any more questions?
And I think the biotech funding environment helps the life sciences tools companies quite a bit. So and that inevitably, that cycle back, given, again, we don't know how the capital markets are going to go, but it's going to be a when that cycle back happens, that's accretive to everyone, because people say, okay, I can see effectively people buy, whatever you want to say, people buy slots or future revenue early on, and then the revenue sort of accrues. And so once that happens, there's a big tailwind that begins across biotechs, and then mid-scale biotechs sort of pile into sort of new indications that are being pursued by the smaller biotechs. So it is a snowball that it will happen again. Maybe not like 2021, but it'll happen again. It's just right now it's very dampened.
I don't really have a question. I wanted to emphasize on Valerie's point about non-dilutive fundings. In case of folks here are not aware, if you're in the oncology space, there is a Texas-based funding or government-funded organization called Cancer Prevention Research Institute of Texas, CPRIT, and they do fund companies that are in the technology and therapeutic space. And obviously the caveat being that you would have to have some presence in Texas. I don't work for them, we just do the due diligence for them, for the companies that they fund. But once they get funds from CPRIT, these companies, they attract a lot of investors. So just wanted to share information with companies that might be in the oncology space and looking to raise money, non-dilutive funds. That's all, thank you.
No, that's a great point. I mean, obviously we're sitting in California, and CIRM certainly has quite a number of programs as well with their clinical translation grants. So that's a very, very good point. So we have about 2 minutes left. So last comments on the space, positive or negative?
Got to be, I've personally got to be positive. I'm very sort of, I've been positive. Nothing's really changed that opinion since I got a very early look at things. I remember, again, from an industry and company perspective, back in sort of 2007, 2008, there were some problems with those companies. I worked with a lot of those companies, and I was like, wow, this is definitely the most exciting place to be. Those were therapeutic companies, and then I found out about the life sciences tool space, and I was like, well, this is very exciting because I could actually like understand the businesses in terms of creating like a profitable model and everything. And I think I think there's, with the demographic shifts that are occurring, I know there's always policy that scares people about the therapeutic industry in general, but with the demographic shifts that are happening, U.S. is the center of innovation for therapy tools, et cetera, you know, and I would really think it's the lower of the probability that we don't have therapeutics and, let's call it, advanced technology and healthcare in general being a big thing for us from 2025 to 2045. I think that it's, in all probability, that becomes a much bigger sector of economy as the demographics shift and everything. So I'm excited.
I just have to say, I mean, having been in this industry for 25 years and seeing a lot of cycles and running businesses through those cycles, you know, it comes and goes. It is absolutely the space to be in. It is absolutely the most rewarding place and industry to be in and sector. And, you know, personally, you know, obviously a lot of motivation for life science tools and industrials, but just like the amazing science and these problems and challenges will be solved, right? Just the realization that it may take us time, we may take longer to get there, but the people in this room and out in that hallway are solving these issues, and it's just incredible to be a part of, so.
Yep. We're at the tip of the spear. I'm an optimist. I'm long on alternative therapies, and I think we are where monoclonal antibodies were 15 years ago.
Thank you all.